Hey, welcome back. Let me tell you about a mistake that has cost retail crypto investors billions of dollars combined. They find a project, the technology sounds impressive, the team seems credible, the community is excited, the price has been going up, everything looks great. So they invest. Then, a few months later, the price starts dropping and dropping and dropping, despite nothing obviously wrong with the project itself. What happened? In most of these cases, the answer is tokenomics. Specifically, a massive amount of tokens held by early investors and founders unlocked and entered the market. And the selling pressure from those unlocks crushed the price, regardless of how good the underlying project was. This happens constantly in crypto, and the people who get hurt are almost always the retail investors who never checked the tokenomics before buying. Tokenomics is the economic engine of every crypto project. It determines whether the token has real reasons to increase in value or whether it is structurally designed to transfer wealth from late buyers to early insiders. Today, you're going to understand tokenomics completely: what it is, how to analyze it, and exactly how to use it to spot projects with genuine winning potential versus projects that look good on the surface but are economically designed to fail regular investors. Let us get into it. What is tokenomics and why does it matter? Tokenomics is a combination of two words, token and economics. It refers to the complete economic structure of a cryptocurrency token: how it is created, how it is distributed, how supply changes over time, and what forces create demand for it. Think of tokenomics as the financial architecture of a crypto project. Just like a building needs sound structural engineering to stand for decades, a crypto project needs sound tokenomics to sustain and grow its value over time. Here is why this matters so much. Two projects can have identical technology, identical teams, and identical market opportunities. But if one has well-designed tokenomics and the other has poorly designed tokenomics, their price trajectories over time will be dramatically different. Good tokenomics creates conditions where demand for the token grows while supply is managed in a way that supports price appreciation. It aligns the incentives of founders, investors, and regular users toward the long-term health of the project. Bad tokenomics does the opposite. It creates conditions where early insiders are heavily incentivized to sell their tokens on regular buyers as quickly as possible. It floods the market with new supply at times that destroy price momentum. It makes the token structurally destined to decline regardless of what the project achieves technically. The harsh reality of crypto is this: a great technology with bad tokenomics will almost always underperform a mediocre technology with great tokenomics in terms of price performance for regular investors. That is why professional crypto investors spend as much time analyzing tokenomics as they spend analyzing the technology, and why most retail investors who skip this step consistently get hurt by projects that looked far better from the outside than they actually were. Supply mechanics. The first pillar of tokenomics analysis is understanding how supply works. Supply has three key components that you need to understand for every project you research. The first component is maximum supply. Maximum supply is the absolute ceiling on how many tokens will ever exist. Bitcoin has a maximum supply of 21 million coins. That hard cap is one of the foundational reasons Bitcoin has maintained its value as a store of wealth. The supply cannot be inflated beyond that limit ever. Some projects have no maximum supply. New tokens can be created indefinitely. This is not automatically bad, but it requires careful examination of the inflation rate and the economic reasons for ongoing token creation. High inflation with no corresponding demand growth is a structural problem. The second component is circulating supply. Circulating supply is the number of tokens that are actually in the market right now. This is the number used to calculate the market cap you see on tracking sites like CoinMarketCap and CoinGecko. Here's the critical insight about circulating supply. If the circulating supply is a small fraction of the maximum supply, a huge amount of tokens have yet to enter the market. Those tokens will be released over time and they represent future selling pressure. Always compare circulating supply to maximum supply before investing. The third component is the fully diluted valuation. This is the market cap calculation if all tokens, including those not yet released, were already in circulation at the current price. If a project has a current market cap of $500 million, but a fully diluted valuation of $5 billion, the market is pricing the project as if only 10% of the tokens exist. When the remaining 90% enters the market over time, there is enormous structural pressure against price appreciation. Always check fully diluted valuation. It is one of the most revealing numbers in all of tokenomics analysis. Token distribution and allocation. How a project distributes its tokens tells you a great deal about whether it is designed to create value for the community or to extract value from it. Here are the main allocation categories you will see in any tokenomics breakdown and what to look for in each. Team and founders allocation. This is the percentage of total tokens given to the people who built the project. A reasonable team allocation is somewhere between 10 and 20%. This gives founders meaningful upside for their work while ensuring they do not hold so much that their selling could dominate the market. When team allocations are above 25 or 30%, you have a small group of people with enormous power to impact the token price when their vesting periods end. That is a significant risk factor. Early investor allocation. Venture capital firms and early investors typically receive tokens at a significant discount to the public price in exchange for providing funding. There is nothing inherently wrong with this. Early capital is necessary for most projects. But when the combined team and investor allocation is above 50% of total supply, more than half of all tokens are going to a small number of insiders who bought at much lower prices than you can. When those tokens unlock, every dollar they make comes at the expense of public market buyers. Community and ecosystem allocation. The best tokenomics designs reserve a significant portion of total supply, typically 30% or more, for community incentives, ecosystem development, grants for builders, and liquidity. This allocation, when well managed, creates genuine decentralization and aligns a broad base of participants with the project's success. Treasury allocation. This is the fund that finances ongoing development. A well-funded treasury gives the team a runway to build for years without being forced to sell tokens to fund operations. Look for treasuries that can sustain development for at least 3 to 5 years based on the team's current burn rate. Vesting schedules and unlock events. Vesting schedules determine when different groups of token holders are allowed to sell their allocations. This is arguably the most practically important piece of tokenomics for timing your investment decisions. Here is how vesting typically works. There is usually a cliff period first. During the cliff period, no tokens can be sold at all. A typical cliff period is 6 months to 1 year from the token launch. After the cliff, tokens are released gradually over a vesting period. A common structure is a 1-year cliff followed by 3 years of linear vesting, meaning tokens unlock in equal monthly amounts over 3 years. Why do vesting schedules matter so much to you as an investor? Because when large unlock events occur, a significant new supply of tokens hits the market. The people receiving those unlocks, the team members and early investors who received tokens at prices far below the current market price, have a financial incentive to sell at least a portion of their unlocked tokens. When millions of dollars worth of tokens unlock in a single event, selling pressure can be dramatic regardless of how good the project news is at the time. Here is the practical step you should always take. Before investing in any project, find the vesting schedule. Most projects publish this in their documentation. Then, go to a token unlock tracking resource and find the specific dates when significant unlock events are scheduled. If a major unlock event is coming in the next 1 to 3 months, you need to factor that into your entry decision. Many experienced investors deliberately wait until after major unlock events before entering a position or size their initial position smaller, knowing they may get a better entry price after the unlock selling pressure clears. Token utility and demand drivers. The final and most fundamental question in tokenomics analysis is this: why would anyone actually want to hold this token? Supply mechanics and distribution are critical. But without genuine demand drivers, even perfectly structured supply means nothing. Price appreciation requires that demand grows faster than supply over time. Here are the demand drivers that create sustainable token value. Utility within the ecosystem. The strongest demand driver is when the token is genuinely required to use the protocol or access its services. If users and developers need to hold tokens to pay transaction fees, access features, participate in governance, or use the application, there is constant organic demand being generated by actual usage. Growing usage equals growing demand. Staking and revenue sharing. Some protocols distribute a portion of the fees they generate to token holders who stake their tokens. This creates a direct financial incentive to hold the token beyond speculation. It also connects the token's value directly to the economic activity of the protocol. More activity means more rewards for holders. This is one of the strongest demand drivers available. Governance rights. Tokens that give holders the right to vote on protocol decisions have utility beyond pure speculation. As protocols grow and the decisions being made become more economically significant, governance rights become genuinely valuable. Burning mechanisms. Some protocols permanently remove tokens from circulation, called burning, as part of normal protocol activity. Ethereum burns a portion of transaction fees with every block. When burn rates exceed new token issuance, the net supply actually decreases over time. Deflationary supply, combined with growing demand, is one of the most powerful tokenomic structures available. Be very cautious about tokens whose only demand driver is the expectation that someone will buy them at a higher price later. This is speculation rather than fundamental value, and speculation-driven demand disappears the moment sentiment shifts. Let me bring your complete tokenomics analysis framework together. Start with supply mechanics. Understand the maximum supply, the circulating supply, and the fully diluted valuation. A massive gap between current market cap and fully diluted valuation is a structural headwind for price. Analyze token distribution. How much do founders and early investors hold combined? Is it below 50%? Is the community and ecosystem allocation meaningful? Does the treasury have sufficient runway? Study the vesting schedules. When are the major unlock events? How much supply becomes sellable at those events? Factor unlock timing into your entry decisions. Assess the demand drivers. Does the token have genuine utility within the ecosystem? Are there staking or revenue sharing mechanisms? Is there a burning component that reduces supply over time? Or is demand driven purely by speculation? The winning projects in crypto share a common tokenomics pattern: controlled and transparent supply, fair distribution without excessive insider concentration, long vesting schedules that align team incentives with long-term success, and multiple genuine demand drivers rooted in actual protocol usage. The losing projects share the opposite pattern: hidden or complex supply structures, massive insider allocations at steep discounts, short vesting periods that allow rapid selling, and tokens with no real utility beyond the hope that prices will rise. Once you can read tokenomics clearly, you will start seeing the difference between these two patterns almost immediately. Projects that once seemed exciting will reveal themselves as structurally problematic, and projects that seemed less flashy will reveal themselves as economically sound. That ability to see past the surface is what separates investors who make money in crypto over time from the ones who are constantly surprised when good-looking projects disappoint them. Tokenomics is not the most exciting part of crypto research, but it is consistently one of the most important. Do the analysis, check every project, make decisions based on economic structure, not just excitement. If this video gave you a clear understanding of tokenomics and how to use it to evaluate projects, please hit the like button and subscribe. Share this with one person who is considering investing in a new crypto project right now. This framework could protect them from a very costly mistake. Drop a comment below and tell me this. Think about the last crypto project you invested in or considered investing in. Would it have passed a proper tokenomics analysis? Tell me in the comments. I read every single one. I will see you in the next one.